Opinions expressed herein are subject to change and not necessarily the opinion of the firm. Past performance is no guarantee of future results. The information presented herein is for informational purposes only and is not intended to provide personal investment advice. It is important that you consider your tolerance for risk and investment goals when making investment decisions. Investing in securities does involve risk and the potential of losing money. The material does not constitute research, investment advice, or trade recommendations.
And now introducing Mr. Keith Lanton.
Hi, good morning again. Hope everyone had a nice week, first full week of January 2020. Got a lot of topics to discuss this morning. Hope everyone is ready for an interesting year. Going to start out this morning. We're going to talk about the financial markets, talk about some thoughts from Barron's. Going to talk about the Secure Act, which was a new piece of legislation that significantly impacts retirement accounts and an area where investors may want to consult with financial advisors, accountants, tax preparers regarding the changes to the law and how it might impact them individually, and we'll talk about some of those provisions as well. As we get started this morning, and as we begin 2020, I hope investors, advisors, everyone is thinking about what it is that they want to accomplish, not just today, not just this month, but this year, this decade, this lifetime. And I wanted to share with you 13 things you should give up if you want to be successful. Now I'm going to cull this list down and not go over all 13, maybe hit on 8 or 9, but thought that this was a good way to get started as we approach this beginning of this decade. So what can you do in order to be successful? Number 1, don't play small. Dream big, don't fear success. Don't be afraid to try new things and follow your dreams. Number 2 is don't expect perfection. Gentleman who started Khan Academy, Mr. Khan, said shipping beats perfection. What does that mean? That means that nothing will ever be perfect regardless of how much we want it to be. It's better to take action. There never will be the perfect time, the perfect circumstance, and in the interim, while you're waiting for that moment, you will lose great opportunities. Despite the fact that we as humans strive for perfection, it's also the case that there really is no such thing as perfect. It's the definition of whoever is creating that word in that circumstance. Don't make excuses. Quote on excuses, it's not about the cards you're dealt, but how you play the hand. You are the creator of your own life. Successful people have taken the matter in their own hands, and they know that they are the only one who is responsible for their life choices, both successes and failures. Everyone's dealt different cards. Some may look better at times than others, but the most successful people play the ones that they have. Don't let your mindset be short-termed. Mae West said you only live once, but if you do it right, once is enough. Beware of the fixed mindset. The future belongs to those who learn more skills and combine them in creative ways, was said by Robert Greene. Something that many of us are guilty of in the internet, social media age. Don't multitask. Winston Churchill, who is quoted way before smartphones, said, "You will never reach your destination if you stop and throw stones at every dog that barks." Don't say yes to things that don't back your goals. Stay on target. Successful people know that in order to achieve long-term success, they need to give up on many short-term gratifications and pleasures in order to reach that destination. Take care of your body. It's the only place you have to live. That's a quote from Jim Rohn. Avoid believing in the magic bullet. This is something to think about, whether you're an investor, whether or not you're an advisor, you're giving advice to someone. Focus on incremental improvement. There is no short-term fairy tale magic wand. Emil Quay said, "Every day in every way, I'm getting better and better." Plan for the future, focus on the present, make the most of every day, and then success will follow. Drop the theory that you can control everything. A famous Greek philosopher said, "Some things are up to us, and some things are not up to us. Learn the difference between the two." Say no to toxic people. Interesting quote from Jim Rohn. You are the average of the 5 people you spend the most time with. And finally, is don't be dependent on TV and social media. Think about this as you go about your day, how you're spending your time, what you're focusing on. The trouble is you think you have time. This is a quote from Jack Kornfeld. Television and the internet have become diseases of our modern society. Avoid using virtual reality as an escape from real life. Unless your work depends on them, you should cut short your dependency and focus your time and energy on more meaningful and important things. So, moving on to the financial markets, as we think about all those things that we could avoid doing in order to have a more successful day in the short term, in order to have a more successful year and decade, and life in the long term. Now we're going to back up to what's just going on in the financial world this morning. So if we back up to last week we saw financial markets rebound from some of the turbulence that we experienced after the tensions in the Middle East. And we had equity markets up here in the United States about 1% on average. The Dow was up 0.75%, and the Nasdaq was up 1.75%. Dow was weighed down by Boeing. Emerging markets were up almost 1% as well, although international developed markets were relatively unchanged. For the year, Nasdaq's now up 2.3%, the S&P's up 1.1%, and the Dow's up 1.1% as well. So far this year, the 10-year Treasury is just up under 1%, so Treasury's still in positive territory, and that is a total return. I'm not talking about yields there. Taking a look at where we are this morning, we're seeing Dow futures up 112 points, S&P futures are up about 12 points, Nasdaq futures up about 43 points over fair value this morning. As markets continue to churn higher, despite some concerns, which we'll talk about. Matter of fact, Kramer on CNBC at the end of last week, who's been relatively positive and bullish, said this is a good moment for profit taking. He wasn't suggesting outright sales, but suggested perhaps trimming and reassessing despite the strength in the financial markets. Overseas, the Nikkei was closed for the Coming of Age Day in Japan, but we saw the Hang Seng up a little over 1%, the Chinese market up 0.75%, European markets relatively unchanged, the FTSE is up about 0.3%, other markets flat to down. Oil's up 12 cents this morning, gold's down $5 an ounce, dollar slightly weaker. Interest rates put things in perspective. The 2-year is a 1.57, the 10-year is a 1.84, the 30-year a 2.30. So back to that positively sloped yield curve. This morning we got news from Lululemon, the company that makes athletic wear. It's up about 2.5%, about 6 points after raising fourth quarter earnings per share revenue and comparable sales guidance also to the upside. This is after some of the more traditional retailers that have been struggling came out with some warnings last week, and we are seeing Lululemon demonstrating that the strong seem to be getting stronger and the weak perhaps getting weaker. Tesla this morning up about 10 points. Oppenheimer raised their target to $612 from $385 per share. Also, Hexcel, symbol Hotel X-Ray Lucky, is up about 3.5% after agreeing to combine in a merger of equals with Woodward, symbol WWD, $6.4 billion deal. Also in the news, AXE, which is Annixter, has agreed to be acquired by Wesco. This is something that's been going back and forth for a while, so not a lot of movement in either stock. It's a $4.5 billion deal. Some upgrades this morning. JMP Securities upgrading Goldman Sachs to outperform 290 target. American Tower, symbol AMT, Apple Mary Tom, upgraded to buy from neutral at Goldman. They raised their target there to 270. JMP did downgrade Morgan Stanley to market perform from outperform as they talked about the financials this morning. Taking a look at what we have to look forward to this week, this is a big week in terms of earnings. And earnings season really gets a big kick off tomorrow when we get the U.S. mega banks reporting fourth quarter and full year 2019 results tomorrow. Citigroup, J.P. Morgan, Wells Fargo all reporting. Also getting earnings tomorrow from Delta Airlines. Tomorrow we get the Bureau of Labor Statistics releasing the CPI for December. Expectations are for a 2.3% year-over-year rise. That's up from 2.1% last month. Core CPI also seen rising to 2.3%. Wednesday we get more earnings: Bank of America, BlackRock, Goldman Sachs, United Healthcare, U.S. Bank Group, to name a few. Also on Wednesday we get producer prices for December. Those are expected to be up 1.4%. And the core is expected to be up 1.3%. On to Thursday, earnings from Bank of New York Mellon, Morgan Stanley, Taiwan Semiconductor. Also on Thursday, Comcast is hosting an investor meeting in New York discussing their strategy for NBC Universal and for their strategy for the Roku competitor, where they have a service where they are providing direct access to streaming content, something that's been getting a lot of attention, and some are suggesting that Comcast has a very competitive solution. Also on Thursday, we get the Census Bureau reporting retail sales for December. Obviously, that's going to get lots of attention. That was Christmas time. Expectations are for a 0.3% gain. Excluding autos retail sales are expected to be up 0.6%, which would be a significant gain. So markets will be seeing if the holiday season met those expectations. And then on Friday, we get the University of Michigan releasing consumer sentiment for January, and that's expected to come in at 99.6. So moving on to Barron's and to a topic that is significant, and that is the new Secure Act, which has changed the rules for stretch IRAs and RMDs. And Barron's answered some questions that have arisen as a result of those rule changes. First, to discuss some of the key points, the Secure Act bumped up the age for required minimum distributions, also known as RMDs, to 72 from 70 and a half, as an acknowledgement that people are living longer, working longer. It'll also allow working seniors to continue making IRA contributions after age 70 and a half. Prior to this, once you hit 70 and a half, you can no longer make an IRA contribution even if you were still working. New rules also upend the strategy surrounding inherited IRAs. Old rules allowed beneficiaries to stretch out required minimum distributions over their lifetime, providing them with years to reap tax-advantaged gains. Now those IRAs must be depleted within 10 years unless the assets are bequeathed to a spouse or an other beneficiary who meets certain exemptions. Some of those exemptions include beneficiaries who are minor children, or beneficiaries who are chronically ill or disabled, or are within 10 years of the age of the person who passed away. Now, some questions. This may apply to you if you're an investor, or you may be getting these questions if you're an advisor. I turned 70 and a half in 2019. How do the RMD changes affect me? Bottom line, if you turned 70 and a half last year, the changes affect you very little. The changes take effect in 2020, meaning that people who turn 70 and a half in 2020 can wait until they turn 72 to begin distributions. But people who turn 70 and a half by December 31st of last year, 2019, those people still operate under the old rules. Put another way, someone who was born in the first half of 1949 has to follow the old rules, while someone who was born in the second half of 1949 does not. That might be a bad news if you're in the second half, if you were in the first half and had to take those RMDs. But a little bit of solace is if you are over 70 and a half, you still can take advantage of qualified charitable distribution, so you don't have to wait till 72. Qualified charitable distribution is a strategy to make a tax-free distribution directly to charities from your retirement account and meet your RMD, and not owe taxes on that RMD because you gave it to charity. So if you're 70 and a half, you still can do that, even though the rules have changed for other things until 72. Question for some investors: I will turn 70 and a half in February. Can I still go ahead and take my first RMD in 2020 instead of waiting until I'm 72? The answer is yes. While you aren't required to take a distribution, you may still do so without incurring the 10% penalty as long as the distribution is made prior to 59 and a half. No matter what, once you hit 72, you will be required to follow the regular distribution schedule. Does the increase to the RMD age for IRAs apply to 457B plans? Yes, it applies to 457Bs, 401Ks, and 403Bs, all subject to the new distribution requirements. One thing that the new rules did do was they terminated the ability to take a stretch IRA. But what if you've been previously taking a stretch IRA, which is the ability to take IRAs before you're 59 and a half, as long as you stretch them out over your lifetime and do not have to pay a 10% penalty. You'll no longer be able to do that, but if you were doing that, you will be able to be grandfathered in. So if you were pursuing a stretch IRA strategy and you had already begun that strategy, you may continue to pursue that strategy. Will the Secure Act change the present RMD restrictions that require taking RMDs the year after inheriting a non-spousal IRA? And that is a question that still is up in the air. You do need to deplete the account within 10 years, but some financial accountants are suggesting that this answer has not been clearly answered yet, and waiting for some clarification from the IRS. Moving on to Barron's and the cover story of Barron's, which was a Barron's roundtable with 10 financial experts who manage money for different causes, different types of investment vehicles, and they gave their outlook on the market. And what was interesting is, of the 10 veteran investors and economists who convened for the Barron's Roundtable, the general consensus amongst almost all 10 was that there was almost no chance of a recession in 2020. Almost all of them were cautious but optimistic about the market's prospects for 2020. They all spoke about high valuations, noted a lack of catalysts to drive stocks higher, bemoaned the fact that it's getting increasingly hard to find good value in today's market. But nevertheless, the general consensus was that we will see modest single-digit growth in the markets. The general consensus was that their concern was with the PE ratios being the primary reason that the markets had moved higher in 2019. Some had quoted that the PE ratio had expanded by almost 4 points, from roughly 15 to 19, which is almost a 20+% increase in PE ratios. At the same time, we only saw roughly a 3% increase in earnings in 2019. So the general theme was that growth would be much more constrained in financial markets in terms of appreciation. It would be more in line perhaps with earnings growth and perhaps some dividends, which gets us to that single-digit upward movement in equity prices if this panel is correct. The panel raised concerns about China. They, in general, whether they were Democrats or Republicans as financial experts, most of them were very in favor of the need for increased immigration. And what was also interesting is there was near unanimity that the next president would remain to be Donald Trump as the president in the upcoming election. One interesting fact that was brought up by Abby Joseph Cohen of Goldman Sachs in talking about immigration is that 14 of the last 37 Nobel Prize winners awarded to the United States in the past 10 years have gone to foreign-born owners. Interesting statistic. Last week was the Consumer Electronics Show in Las Vegas. Gets lots of attention in terms of upcoming exciting products that may become available in the technology or the electronic space. And there are a handful of takeaways that Barron's discussed from the CES in 2020. One is that they agree that 5G is going to be a big deal, but they say it may not be in the way that most people think. They point out that 5G will hit the mainstream in 2020, but they think it will take longer, a couple of more years, before you start to see the real benefits and the productivity gains that are the result of 5G. They also suggest that the real benefits of 5G are hard to quantify, as applications are still in development, and some of the real winners and the real benefits to consumers may come from ideas that we haven't heard yet, or companies perhaps that are private or even forming as we speak. That's where they think that the real benefits from 5G will come. So perhaps 5G will take a little longer to manifest itself in terms of productivity gains and the ability to leverage that increased speed. And they also point out that increased speed may be a little slower in coming than some consumers would like, depending on where they live. Interesting takeaway on self-driving cars. The near unanimous conclusion from the authors was that autonomous driving is still a long way off, a lot further off than some people had expected even a year or two ago, and what looks to be a lot closer than autonomous driving, which some of the folks at the CES were suggesting maybe at least a decade away before we get to autonomous driving. But a lot sooner than that is what is known as ADAS, which is here now, which is Advanced Driver Assistance Systems, which will allow cars to take over in certain situations, kind of natural progression, perhaps before we get to autonomous driving. And the companies that seem to be the lead in terms of autonomous advanced driver assistance systems are NVIDIA, Qualcomm, and Intel's Mobileye unit, all showing off autonomous driving platforms at the show, but they're focused on ADAS, Advanced Driver Assistance Systems, not full-blown self-driving cars. Also at the CES, one change from years past was very little emphasis on new TV technology in the sense of more dazzling displays, bigger televisions. That seems to have, at least at the moment, plateaued, and the real focus, as you can imagine, is on the content, not on the hardware. And finally, the other big takeaway is the issues with privacy. Privacy getting lots of attention at the conference, with possible privacy improvements from Apple, Facebook, Google, all spending a lot of time discussing how they are going to address consumers' concerns with respect to their data gathering strategies. So I'm going to talk about two more stocks. One is Apple. Apple written up in Barron's. Lots of investors own Apple. Lots of advisors have clients that own Apple, and lots of people are asking, at least I've gotten questions, what do I do? I've got all these gains in Apple. Do I pay tax? That's in my retirement account. Do I sell it? I don't have to pay tax. And it's not an easy question to answer. And Barron's took a stab at it, and they ran an article entitled, Apple Made Investors $500 billion last year. Time to hedge your bets. So Apple last year up 86%, adding a staggering $570 billion in new market value. That 12-month gain in Apple is more than the total value of but four other companies in the S&P 500 index. So more gain there than 496 companies' valuations, not combined, but independently. At its current $1.4 trillion market cap, Apple is swamping public indexes and individual portfolios. Barron's saying a typical diversification strategy would argue for taking profits, but there's nothing typical about Apple, which continues to defy the law of large numbers, and they say when they're taking a look at the stock, it makes sense to start with the valuation. After years of looking cheap, they say Apple shares are now pricey. The stock trades for 24 times Wall Street's projected PE in 2020, which is $13.03 a share. The S&P 500 is at 18 to 19 times earnings, depending on what earnings metric you're looking at. Typically, Apple, over the last 10 years, has traded an average PE of 14. Just 13 months ago, when Barron's picked Apple as one of its top picks for 2019, the forward PE on Apple was just 13. What's interesting is that when Apple has surpassed 4% of the markets of the S&P 500's total market value, which it did in last October, and it surpassed that 4% mark of the S&P 500 6 times, and in each of those times, Apple has on average underperformed the S&P by an average of 9 percentage points over the following 12 months. So Barron's is suggesting caution, suggesting that perhaps there's not material upside from here, even though they don't disagree that Apple has been a wonderful investment and is still doing exciting things. But they surmise that Apple sales are expected to be $275 billion this year. That's about 6% up from the previous year. But when you're looking at the PE ratio and the excitement around the stock, they say it's trading more like a startup, but its growth is looking more like a regulated utility. So what do they suggest people do? Generally, basically what they say is they suggest not selling the stock outright, but they suggest selling the stock if you can, if it makes sense for you, perhaps down to your original investment. This way you can still participate in the future upside and play, so to speak, with the house's money because you've taken your profits off the table. If you're looking for other companies that perhaps could provide better risk-reward ratios, but still want to be in the technology space, they suggest the Taiwan Semiconductor, symbol TSM, which is a customer or client of Apple is a client of theirs. They make lots of the chips for Apple. They also suggest, and this is on the much more aggressive side, Datadog, symbol DDOG, recent IPO. They are a leader in monitoring cloud applications, which they say puts them in a prime position to benefit from the cloud's continued growth. Changing gears, one last story. Barron's discusses the big banks, and they ran a feature article on Bank of America. U.S. banks last year were up about 40%, including dividends. So is it still a good time to be investing in the banking sector? And Barron's came out saying that even though bank stocks have historically not done well in slumps, including a disastrous showing, as most of us may remember in the financial crisis, they conclude that, in their opinion, the big banks are stronger than ever, and that there is a bull case for remaining invested, or if you're not invested, of getting invested into the big banks. One that they featured in this article, they speak very favorably of specifically, is Bank of America, and they say thanks to its national banking franchise and its lucrative wealth platform anchored by Merrill Lynch, Bank of America, they feel, can trade up into the low 40s or perhaps 50 over the next 3 years. They say the Bank of America have aggressively been buying back stock. They bought back $31 billion in stock in the fiscal year ending in June 20th. Bank of America is being quoted in this article by analyst Mike Mayo of Wells Fargo. He says is delivering on the promise of national banking. Mike Mayo has an overweight rating on the stock, $42 one-year target, $50 three-year target. At a recent price of about $35, the stock trades for about 12 times 2020 earnings of $3 a share, also a 2% dividend yield. And Bank of America is now Warren Buffett's favorite bank, and that's measured by his ownership, not necessarily by anything he said. But Berkshire Hathaway does own a 10% stake, the maximum permitted. Buffett is also a big fan of the CEO Moynihan, calling him one of the most underestimated of major bank CEOs last year. The article quotes an analyst at Barclays, Jason Goldberg, who says that Bank of America has made substantial improvements in its technology, also has invested heavily in its consumer bank, and that's not fully appreciated by investors. Last week, he upped Bank of America to overweight from equal weight and set a price target of 43. Now, Bank of America is expected to release earnings we discussed on Wednesday. They're expected to show a profit of 69 cents a share, which is down 1 cent from 70 cents a year earlier, reflecting the impact of lower short-term rates and continued investments. And these analysts feel that that expectation is baked into the cake, so to speak, and they remain optimistic about the longer-term prospects of BAC, Bank America. That's everything I've got.
Thank you for listening to Mr. Keith Lanton. For more podcasts, please visit our website, www.lanternwa.com.